If you stay with me until the end of this video, you'll finally understand one of the most confusing and most profitable patterns in the entire investing world. Why the stock market begins rising before interest rates actually come down. And once you understand this timing, you'll be able to read the market with a level of confidence most investors never reach. Because this single pattern has predicted nearly every major bull run of the last 50 years, and yet most people completely miss it. They wait for the headlines, the announcements, the confirmation, and by the time they finally feel safe, the biggest gains have already happened without them. Here's what makes this so fascinating. Most beginners think the market reacts to interest rate cuts the way a light switch reacts to a finger. You flip it down, and the room brightens immediately. But that's not how markets work. Markets move on expectations, not events. They react to whispers, not confirmations. And what absolutely blows my mind is how consistently people confuse the moment the Fed cuts with the moment investors start pricing in the cut. Those are two completely different timelines, sometimes separated by months. Think about it. When interest rates come down, borrowing becomes cheaper, businesses invest more, debt gets lighter, consumers breathe easier, and growth accelerates. Everyone understands that part. But investors aren't paid to react to what everyone already knows. They're paid to anticipate what everyone else will only understand later. So instead of waiting for the official announcement, they analyze signals, inflation trends, job numbers, yield curves, corporate guidance, credit spreads, and when those signals start turning in the right direction, money begins quietly flowing back into the market long before a single rate cut is official. And here's the twist most people never see coming. Historically, the biggest gains often happen during the period of rising rates, or right before they start falling. That sounds backwards, right? Why would the market surge when borrowing is expensive, companies are stressed, and consumers are tightening their belts? Because investors aren't reacting to the present. They're reacting to the future. A future where lower rates mean stronger earnings, bigger margins, and higher valuations. A future where cash becomes more valuable when deployed, not when sitting in a savings account losing to inflation. A future where economic gravity finally shifts in favor of risk assets again. So millions of people do the exact opposite of what the smartest money does. They wait. They hesitate. They say, "I'll buy when the Fed cuts." But by the time that headline finally hits their news feed, the rally they were waiting for has already been running for 6, 8, sometimes 12 months. And that's why this video matters. Because by the time we're done, you won't just understand why the stock market rises before rates fall. You'll know how to identify the signals that it's starting, how to avoid the trap of waiting for confirmation, and how to position yourself so you're not chasing the upside after it's already gone. Whether you're a long-term investor or someone trying to time the next big momentum shift, this pattern is one of the most powerful tools you can have. So stay with me, because understanding this timing could change how you invest not just this year, but for the rest of your life.
The stock market is rising, and the Dow just hit another record. And yet, interest rates are still high. That doesn't make sense, does it? High rates are supposed to slow the economy, not push stocks higher. So what's really happening here? Why are markets celebrating while money is still expensive? Because the market isn't reacting to what's happening now. It's reacting to what it believes will happen next. And once you understand that logic, you'll never look at headlines the same way again.
Right now, the U.S. stock market looks unstoppable, with both the Dow Jones and S&P 500 reaching near all-time highs. Despite this impressive rally, interest rates remain elevated, and the Federal Reserve hasn't rushed to cut them, even after inflation has shown signs of cooling off. This seemingly contradictory situation raises a key question. How can stocks rally while borrowing costs stay so high? The answer lies in investor expectations, which are forward-looking and prioritize future economic conditions over current rates. A robust economy, defying recession predictions, and strong corporate earnings, particularly in technology fueled by AI advancements, are key drivers. Investors are anticipating future interest rate cuts, which would further boost corporate profitability and market sentiment. Cooling inflation also supports expectations of a less restrictive monetary policy, easing concerns about the Federal Reserve's stance. While high inflation can reduce the present value of future cash flows, cooling inflation helps maintain positive valuations. The rally is also broadening beyond large-cap tech, with small-cap stocks in sectors like healthcare, gold, and aerospace and defense showing strong outperformance. This indicates increased market breadth and a more resilient overall market structure. Ultimately, the market's record highs amidst high interest rates are a complex interplay of future expectations, economic strength, and dynamic sector growth. Investors will continue to closely monitor Federal Reserve policy and economic data for signs of the rally's sustainability.
This isn't the first time we've seen this story unfold in the financial markets. Back in 2004, the Federal Reserve began raising interest rates, initiating a cycle of 17 small increments. The primary goal was to cool down the economy and slow inflation, which is a common strategy for central banks. But the stock market didn't collapse. Instead, it kept climbing for almost 3 years, defying conventional expectations. This happened because investors anticipated that the Fed's actions today were setting the stage for easier money later, pricing in future expectations. Fast forward to 2018, and rates were rising again, with headlines warning that economic growth would slow. Yet, by mid-2019, the market was already hitting new highs, even before the Federal Reserve officially cut rates. This demonstrates the market's forward-looking nature, where anticipated events are often reflected in current prices. The same logic is playing out right now, as investors assess the current economic landscape. Even with rates still high, the market sees what's coming, a cycle shift, not a collapse. Economic forecasts, like robust GDP growth and declining unemployment, signal a favorable environment for equities. Investor psychology also plays a role, as dovish language from the Fed eases concerns and allows the market to resume its bull market trajectory. Because in finance, the crowd often reacts to the present, driven by immediate news and sentiment. But the professionals, those with a deeper understanding, they invest in the future, anticipating long-term trends. Savvy investors look beyond immediate interest rate changes, focusing on the future economic landscape and making informed decisions. The question most people ask is simple. If interest rates are still high, why is the market rising? Because the market doesn't react to what's happening today. It reacts to what it believes will happen tomorrow. Every stock price, every index number, is a reflection of future expectations. When investors believe inflation will slow, or that the Federal Reserve will eventually cut rates, they don't wait for confirmation. They move early. That's why markets rally long before the economy feels better. By the time headlines say the worst is over, the smart money has already taken position. This is the difference between reacting and anticipating. The average investor waits for proof. The professional prices the future. Because markets are not mirrors. They're time machines. They live 6 months ahead of the present. The truth is, the market almost always moves before the economy does. When the data still looks bad, when unemployment is rising, when fear fills the headlines, that's usually when the market quietly turns. Because it's not reacting to what happened yesterday. It's positioning for what's about to change. That's why bull markets are born in moments of pessimism, and why the biggest rallies often begin when confidence is at its lowest. The market moves first. The economy catches up later. It's not intuition. It's structure. A system built on expectations, not emotions. Every cycle follows the same rhythm. Hope, growth, fear, recovery, hope again. The crowd reacts to fear. The investor recognizes the cycle. That's what separates speculation from wisdom.
Every market story sounds different on the surface. New headlines, new numbers, new fears. But underneath, it's always the same rhythm. Rates rise, people panic, markets pause. And then, slowly, they recover, long before anyone feels ready to believe it. That's the nature of cycles. They turn when emotion peaks, not when logic says they should. The market isn't testing your money. It's testing your patience. And that's why the difference between a trader and an investor isn't strategy. It's perspective. The smart investor understands the cycle. The average one reacts to the moment. And in that difference, wealth is quietly built. So before you react to another headline, ask yourself one thing. Am I seeing the moment